Hey everyone, Mark Hart here from Memphis Investment Properties, and I am pleased and proud to introduce our next speaker for the 2020 SOFA Summit, Mr. Aaron Chapman from Security National Mortgage. Aaron, how are you today?
Doing very, very well, Mark. Thanks for inviting me out to participate. Let me always be part of your guys' events.
Yeah, it's our pleasure. We love having you. So, Aaron Chapman is one of our top preferred lenders. He's able to give conventional loans to our investors so they can grow a portfolio of single family homes. But he also does so much more than that. What I personally love about Aaron is his ability, and his team will actually fight for you. And in terms of what that means and what that looks like for financing and getting a mortgage is just one investor we're working with right now. He was trying to buy a property from us using a different one of our lenders, and they said that he couldn't give them the loan. So we thought we were going to have to cancel the deal. But then we gave Aaron Chapman a call, and through some magic of his own, he was able to figure everything out, and we should be closing here sometime next week. So without further ado, Aaron, why don't you share your screen and take it away?
Thank you, sir. So one I got to say is that particular magic you're talking about happens to be the team, because I'll just say they're the wizards behind the curtain. I'm the smoke mirrors and BS. I've been at this since 1997 and been blessed this last 5 years to really start building that team that I envisioned years ago. No, not 19. It's 2014, Carl. Imagine you're getting kind of older when you're going back to the last century when you're trying to remember stuff. But so I'll be talking one-handed. I got a shoulder surgery here, and so I'll be kind of struggling here with the sharing stuff, trying to use my left hand to accomplish things. But 2014, I was standing in line at a Chipotle, waiting to get to a chance where I can do my order. I was getting lunch for my one employee, Ellen Schmidt, and I was counting all the heads behind the counter. I noticed 11 people working back there. Between the 4 up front building the burrito, and then all the people in the back, and people walking around cleaning up. And so what I started building in my mind was a process that followed that same system with people within my team to help build a intricate financial instrument like a mortgage, where it's interesting how they need 11 people to be successful in burrito construction, yet I only had 2 of us building out these loans. So now I've been blessed to be able to say I've doubled the Chipotle method. I'm at 22 members of my staff right now. I'm adding another one here real soon, because unfortunately my calendar is only so big. I only have so many hours in the day, and I'm already booked out till Friday. So I have to put somebody on here who understands the real estate investor very well to back me up in that conversation I'm having with people. And we're going to have that conversation together right now. So one of the things I like to really dig into is the real power behind real estate, where people get really caught up in reading online and looking at what's being posted out there by most people. And it seems to be the same regurgitation of cash flow, and cash and the cash on cash return, which are not bad metrics. You guys use the cash on cash return model all the time. You have pro formas that you're providing to people. Well, what I want to be able to give people the information wise to think about is the pro forma is really designed for one thing. The pro forma is designed for a person to be able to do a 30,000 foot flyby at Mach 2 and look at a bottom line and see enough information there to slow it down, right? And then just kind of turn their machine around and look at that a little bit closer. And the reason I want them to look at that closer is to understand that the value of the real estate is somewhere else. Now, the cash on cash return model, the pro forma, how that breaks it down, that's going to give them a reason to stop and look at it. So let me break down what I believe is the most powerful points behind investment real estate. One is your team. You can't beat having the best team out there. I don't care if you have the crappiest house in the neighborhood or a house built out of solid gold brick sitting on the hill overlooking the bay. Either one is going to be heavily affected by your team and how they operate that. So what I try to really help people understand is they're starting off to become the CEO of their own real estate investment firm. They have to look at this as a business. Like a consumer spending money and going into debt, this is a business that they're proposing to purchase. And they're purchasing, every property purchase is a business. So let's take your guys' operation, for instance. You're going to come and work with Memphis Investment Properties in Memphis, Tennessee. And by doing that, you have now taken on a regional operations division, a group that will source, acquire, rehab, manage, and maintain the business, correct? Am I even remotely off on that?
That's correct.
All right, so now you have an operations division running, right? You got people that are taking care of that aspect of it, that know the market, boots on the ground. Now, being the fact they're a CEO in their business, they're sitting at their board table, got the operations side handled. What about this finance side? Well, I'm trying to propose that I do a little bit more than just be the guy who quotes rates, locks in rates, and gets loans funded, and sends you a card at your birthday. I'm looking more like trying to occupy that fractional CFO position, if you will, or at least a trusted advisor at your board table. Now, Mark, you've probably heard me say this 1,000 times, but I'm going to say it again. There's an old saying, good judgment comes from experience, and experience comes from bad judgment, right? Hence,
That's
what
correct.
makes Memphis investment property so powerful is the good judgment that you guys have because of the experience that Mr. Reedy's got. There's hardly anybody in Memphis that's got the experience that he has. Makes you guys a very powerful team to work with. Well, I need to offer my experience to people if they're even going to remotely trust me to take a seat at their board table, right? So I'm what they call a licensed loan originator. You go to my website, aaronbchapman.com, and take a look and see what my licenses are. There's 26 of them, I think. Could be off on that. There's so many anymore, I can't keep track. But there's 300,000 people in the United States that are licensed to do what I do. And when you look statistically speaking, the average person in my industry does between 3 and 4 transactions per month. Being that fact that we're in a refi boom, probably about 6 to 7, let's say. Really kicking ass, they're doing double digits. Last month, I closed 123. The month before was 107. The month before that was 134. And I've been doing this since 1997. We don't, and if it wasn't for my team, we wouldn't be able to pull that off. But ultimately, when you're talking about the experience thing, the average person is doing 3 to 4 a month. I'm doing 6.6 a day. So we get to see where a lot of people are making decisions about their business. We get to see where a lot of people are failing. We get to see where a lot of people are succeeding. So when you're coming into this, you start working with Mark and team, and you have questions that you've never faced before, when you're having decisions that you've never had to make before, just know that we've seen a lot of people make those decisions over the past, myself and Mark and Mr. Reedy and all the other folks within the organization and on my team. I've got team members that have been with me for 10 years. I've got team members that have been doing this since 1982. They have people that have seen where those decisions were, and we can guide you with practical data from where we've seen other people operate. Now, the real value of the real estate is not just your team. I mean, that's to me the most value in the real estate. It's having the right team to operate it. Where we really start to get into value here is when we start getting into some math. So Mark, are you cool with doing a little bit of math with me?
Let's do it. Let's make it happen.
And it's real simple math. And the reason I do that, I do it with all my clients, especially the first time, is have you ever heard of Dr. Joe Dispenza?
I've heard of him. Yeah.
Okay. So I'm going to tell everybody that's watching this, do a Google search, Dr. Joe Dispenza, Dispenza, TEDx Tacoma. So you're going to watch his speech on a TEDx in Tacoma, Washington, and he talks about a lot about the neural pathways. And as you think, you can get neurons to connect with another neuron, you get new ideas, and as long as you continue on that thought process, you can create a whole new neural network. It's pretty amazing stuff, and it really gets back to you think correctly, you actually have correct impulses. You think incorrect, you can have incorrect impulses. And so I'll let you guys watch that and let him share how awesome that is. Now, getting into the reason why I bring that up is because if we're doing math together, it forces you and anybody who's watching here to do the math with us so you can actually start building neural pathways associated with actually seeing these numbers. So what we're going to do is we're going to set a baseline. We're going to do a $100,000 property, 20% down, 30-year fixed, 1% rent to value ratio with a $200 a month cash flow. Does that sound like an off situation to you?
We can make it happen.
Okay, so that just sounds like that sounds like a deal it's not fictitious, right?
Correct.
Sounds like a real deal. Okay, so let's say that working with Memphis Investment Properties, you get that $100,000 property, it gets rented, it stays rented for the majority of the time you own it, reasonably the most of the time, right? So we've got a $100,000 acquisition, 20% down. What is the dollar amount of the loan on this one, Mark?
The dollar amount that you're going to actually finance for this?
Correct. Correct. 20%
$80,000?
down, 80,000 bucks. Yep. So 80 grand. So that's the kind of questions I'm going to be asking here. So $80,000. Well, if you divide that 80,000 over 30 years, because if you're keeping it rented for the majority of the time you own it, who's really paying off that loan?
That's going to be your tenant.
The tenant. So let's say your tenant's paying that off. You got 80,000, takes them 30 years to do it. How much is that per year? So take 80,000 divided by 30 for me.
Get a calculator for that.
Oh yeah, better get that sucker close because this is not where it stops.
Oh, real quick. Here we go. Divided by 30. $2,667 a year.
Yep. So if we want to get precise, it's $2,666.66, and the six keeps going.
Correct.
So now take that and divide that into the 20,000.
That will be 0.133333.
Exactly. So what that means, for those who are paying attention here, you'll take your tenant 30 years to pay off your $80,000 loan at an averaging over the 30 years. I know there's an amortization table. We're taking averages here. An average of $2,666.66 per year. You divide that dollar amount, because that's what they're paying down for you, into your investment of 20 grand. That means your 20 grand is growing by 13.33% of the original 20,000 every single year, regardless of cash flow, regardless of appreciation or tax benefits or hedge against inflation, anything else. That's just the growth on your investment. If a person offered a bank account to you where you put in 20 grand, they'll continue to add 2,666.66 to it every year, you probably wouldn't shy away from it.
I'll
right?
take two.
Exactly. Exactly. Can we have one per person in the household, please? Right? And
Right.
we would willingly do that. So now let's talk about, so we're going to shelf that for a minute. We know where that's coming from. We live in an inflationary environment, correct?
That's correct.
You know what the rate of inflation is today?
Well, it depends who's calculating it.
Yeah, it depends upon who you're talking to, right?
That's correct.
So the rate of inflation today, as determined by the Fed, they've got two measures of inflation. They've got the CPI and the PCE. So the CPI is Consumer Price Index. The PCE is the Personal Consumption Expenditures Index. Now, they both, the way that they're written, right? They sound like they're following along with what everybody's spending money on, right? So personal consumption expenditures, consumer price index, to me, they're the most mislabeled damn things on the planet because they don't follow some of the most key things that people spend the money on. So what is the four things a person needs to survive, that a human being needs to survive?
Food, water, shelter, and love.
Well,
Puppy.
puppies maybe. So I say air.
Yeah, true.
You can't breathe, but they have yet to figure out how to tax air. But I think they have figured out how to tax love. If you see how have you seen certain things, right? So I mean, marriage tax and all kinds of stuff. And so food, water, shelter, air. So since air is not taxed, not yet, at least, let's set that aside. But they have not added in to either of those metrics, food costs, energy costs, and parts of housing. So when you're looking at food costs, has it gone down?
Food costs, has it gone down? No, sir.
No, in fact, if you look at the meat index, it's over 18% increase year over year. You go to energy costs such as water. I mean, what is water? Has your water bill gone down from what it was before? I mean, I'm not talking about usage. I'm talking dollar per gallon used.
Correct. Going up.
Going up, right? So of course they're not factoring those in, because when you factor that in, John Williams' Shadow Stats will show, and I encourage everybody to go to shadowstats.com, look at the alternate data. It's over 7%. Up until the COVID mess, because of what's happened with oil, it was in excess of 10% nationally. So let's say we're about 7.8% right now. So we're just going to use 7% as our number. So because of that inflation, we get to raise rents, right?
Correct.
So what I've seen nationally, I'm not sure about, you can speak to Memphis for us, but in nationally, I'm seeing rents raising by 3.6% just in apartments. What is it doing in Memphis annually? At least a guess.
So Memphis, we're actually pretty blessed that during COVID, an article just came out the other day that said we have the second fastest rent appreciation in the entire country post-COVID. and that's just over 1%. But we come in just a little bit under 2% on average on the single family home side year over year.
Okay, so 2% year over year, so 2% increase in rents. So what is 2% of this? So we set our rent at 1% rent to value ratio. So how much is that per month in rent?
$1,000.
$1,000. Okay. So how much is 2% of 1,000?
$20.
$20, right? So if you had $200 a month cash flow year one, what can we estimate cash flow to be year two with a 2% increase in rent?
Well, the benefit of Memphis investment properties is that we actually have a 4% rental increase in our lease between year one and year two. So boom, it's actually going to be $40. So $240 in total. So go up. So 240 is what you should expect.
240, yes, definitely go you guys. Yeah, I that's awesome. So if you're at a $40 increase, what is that increase in percentage?
40 divided by 200?
Yeah.
20% increase.
20% increase. Guys, listen to that. 20%, that's a compound increase. Every time you raise rents, that's a 20% growth. So too often I see people, well, my cash flows are not real high. It's like $180. I'm like, well, who are you working with? And what is the rents? Who gives a damn what the cash flow is the first year? It's what's year 5? Right? Look at the compound that's going on here. This is ridiculous, right? Okay, so let's set that aside. You get a 20% compound growth on your rents. Even if you only went to 3%, that's a 15% compound. So look at that. You did 2%, that's a 10% compound. That's bigger than most anything else you're seeing out there available in the rental world. I mean, well, not the rental world, but in the investment world. That 13.33% growth on the original 20,000. Now you're looking at 10, 15, 20% compound on your cash flow. We have yet to really get to the sexy stuff, right? So set that aside. So now we're looking at what inflation does to the dollar. So if we're saying a 7% inflation nationally, which is actually higher than that, what's the value of the dollar doing?
Increasing at 7% every single year.
It's actually declining by 7% every single year.
Correct.
Yeah. So, yes. Which is good. It's good that because we need a person, because there's probably a lot of people that were thinking that, right? It's amazing how often, just the way the word is coming across, you might think one way. So there's a lot of people paying attention here that were thinking the same thing. No, your buying power declines.
Going up, but the value of the dollar is obviously going down.
Exactly. The cost of goods are going up. The spending power of the dollar is declining. So that's a big deal for us to consider. So let's think about this. We get to raise rents because the value of the dollar is going down, but do they get to raise the payment on this loan because the value of the dollar is going down?
It's hard no.
Hell no. Is what that is.
Fixed. Hell no. Hard no.
Fixed for 30 years. So what we're going to do is we're going to look and see what that actually does for us here. I'm going to share a screen. In fact, let me see here. So can you see this this spreadsheet?
Yep, we got it.
Okay, so what we got here, I'm not going to change this date here to 8/30/2020. So let's say we're closing on 8/30 of 2020. We got an interest rate of, it's actually, the rates are much lower than this, guys. I'm not scaring you the hell off right now. I'm just showing you a nominal rate for us to work off of. I'm just going to work a rate of 4.5. We're in the very, very low 4s right now. We're locking rates. Definitely something to talk about. But I want to show you even a worse scenario, because I always like to paint the picture. Rates don't matter. So I'm going to show you something higher, about 0.5% higher than what I've been locking at lately. 20% down, 4.5% interest rate, 30-year fixed, 12 payments per year, $100,000 purchase, like we were talking about, $80,000 loan amount. That's a payment of $405.35 per month for 30 years, right? So we have a principal of $80,000 right here. We've got interest collected over 30 years at 4.5% on that $100,000 purchase, $80,000 loan, $65,925.37. That means over the 30 years, you're going to pay, or you're going to filter through your hands, keep the excess, and hand over to the bank $145,925.37. Now, Einstein himself said that compound interest is the 8th wonder of the world. This is compound interest at work. This is where some people are saying, man, I want to use my cash flows. I want to do the debt snowball. I want to pay this thing off as fast as I can. I'm going to tell you, no, quit that. The reason I'm going to say that is because you get to raise rents. you get to increase your cash flow. That's your money that you get to keep as you pass through to your business partner, which is the lender. They are only collecting $405.35 per month for all that 30 years. When you recalculate every dollar and its value as it leaves your hands for that 30 years, compare it to the value of the dollar the day you receive that $80,000 to buy your business, you're not paying the $80,000 principal. You're not paying the $65,925.37 in interest. You're definitely not paying the $145,925, even though that's how many dollar bills left your hand. You're paying over here $60,926.91 in actual dollar value. If you look at the value of the dollar 30 years from now, that $405 payment 30 years from now is equal to $49.94 today. Look at the difference. So you leverage high, you leverage long, and you pay off slow, period. There's no argument here. Now, these are not my numbers. What I'm showing you here comes from the professor of accounting at Kennesaw State University and some of his students and some of his other professors that are on staff there. They heard me on a podcast talking about this. They called me. They asked me to come to their university and speak to their students. They presented me with this tool to actually prove my theory correct. Now, the theory wasn't even really a theory. It's something people have been talking about forever, but nobody put numbers to it. I got numbers. What's really cool about this is going to be an app in no time. It's not going to be very long, and I'm going to have an app built out for everybody to have access to this. So that is one of the most powerful things that we could possibly see, is that you get to borrow the money for 30 years, but you never even pay back what you borrowed. It's one of the sexiest things in the whole real estate world. So any questions in your mind coming up about this that you think people might be asking?
Is it too good to be true?
We got numbers to back it up. And
right.
Not only the numbers to back it up, I think Professor Abernathy is a client of Memphis Investment Properties as well. So there's a little bit of some numbers. If the numbers weren't true, he wouldn't have been coming out there to Memphis himself. In fact, that's where I finally met him face to face, was in Memphis at one of your events. So that's that whole situation there. Now, one of the other things I want to get into, because people really get worried, well, what does it look like if the interest rates go up? Well, there is that is definitely a chance. We definitely see that could potentially happen. So what I'm going to show you here is what the rates have looked like. This is the mortgage-backed securities pools. This shows all the way back to, let me see here, July 26, 2018. So this shows the trend of the market. What it has to do with is where mortgages have adjusted as far as rates is concerned based upon supply and demand of money. So what you're seeing here is all these little bars here. I'm going to zoom in on that to kind of show you what things look like. Each one of these represents 1 day's worth of trading. Money going into the mortgage-backed securities, money basically trading in and out of it on a daily basis. If it's a red candle, that means it's where it started was higher, where it ended was lower. People sold their positions, or less money went in than when it went out. If it's green, it means more money went in than where it started that day. And you can see where it spikes either direction. Well, it's staying fairly flat right now. The reason I want to show you all of this is we've closed a lot of loans at any position in here, because in reality, interest rates don't matter. I know people are going to get worried that, man, if I don't take advantage of the rates today, I'm going to lose out later. You're really not, because we live in a very, very tax favorable environment. Because the way the taxes is structured, it benefits real estate investors so much that it really doesn't matter. But let's get into what's going on here in this anyway. So what we have here is interest rates stayed in probably the mid to high fours up until this point right here on March 9th. So do you remember what happened in early March, Mark?
COVID, baby.
COVID came in and the stock market crashed as a result of COVID. So we house our money in banks, right? And banks don't just take our cash and put it in a vault and let it sit there. They put it to work in the market somewhere to make money off the money that we have on deposit, correct? Well, when that happened and the stock market crashed right here in early March, I think it was March 6th and 7th. I got to go back and look, March 6th or 9th, when it really hit hard. Well, banks don't just put what they have on deposit in there. They go on margin, right? Very similar to the real estate investor is doing with getting a leverage, but they're leveraging it in the market, which swings rapidly. Well, when this market crashed, margin calls came. They had to start pulling capital. Where could they pull capital from? They couldn't pull it from the vault. They had to sell off hard assets. Part of the hard assets they held was mortgage-backed securities and treasuries. other bonds. They sold those bonds, and we see the market just got pummeled. Interest rates spiked as high as 5.75%, costing 2 points. Now, all the way back here, we weren't that high back here. But as you can see, it's not even as low as it was back in here when it was, at that point. But what reason being, the uncertainty in the market forced all of that. And we forced these interest rates to spike. Well, here's where the Fed jumped in. Fed jumped in at March 20th. It's kind of hard to line up. There you go. Fed jumped in on March 20th and started throwing money into the mortgage-backed securities. Now, when I'm speaking in Memphis, quite often I talk about 2009 when quantitative easing started, up until the end of March 2010 when quantitative easing slowed down. What it was is the Fed dumping capital into the market to stabilize the rates and get the economy back on track. They put in 1.25 trillion from January 1 to the end of January 1, 2009 to the end of March 2010. That's huge. $1.25 trillion. I mean, everybody in the audience I know was just scratching their head. How is that possible? Right here from March 20th up until March 30th, right here, the Fed dumped in over $1 trillion in that window. Wrap your head around that. 10 days, 10 business trading days, the Fed dumped in as much or almost as much as they did in that 1 year and 3 months. Now, the Fed during this period here, I'm gonna zoom in 3 months, they're the ones that's driving this. They're putting anywhere back here is $8 to $10 billion a day. Here it's pretty close to between $4 and $5 billion a day to keep it here. Now, eventually the Fed's going to divest. I don't know when. So what I tell people is you definitely want to get as involved as you can right now. I mean, this is historic. But the Fed has said they got an open checkbook up until 2022. Doesn't mean you sit on your hands, because they're also involved in a lot of other stuff. Let me show you something else the Fed just got done buying into. I'm going to cancel this screen share. Start another screen share here. They're buying corporate ETFs. Right now, you can see where this spiked down and they jump back in. They're the third largest holder of some corporate bonds in the entire world, the Federal Reserve. The worry I have about that is we have a price agnostic investor putting money into the markets strictly for the case of liquidity. Well, what happens when they decide to divest? Everybody who was investing in it before have no basis for what the real value is right now. Right. So we've got a little bit of a mess on our hands. And the reason I bring up this mess is not to freak people out, not to get them all shaken up, because I mean, it's definitely something to get concerned about. As far as I can tell, as far as I can see in anything else, the most stable investment is the long-term housing with single families, 2, 3, 4 unit buildings. I know a lot of people want to graduate to that. I want to have a 100 unit apartment building. Guys, we're living in an interesting world right now with COVID. When you look at what's going on with COVID, people are sheltering in place. What do you think it's like to live in a 2-bedroom, 1-bath with 2 kids trying to work from home? It can't be enjoyable.
Let's just say they don't want to live there anymore.
Exactly. It may have been fine for a while. Right. But now it's like, damn, man, a backyard would be awesome because you can't use the common area in many places. Right. That being the case, I'm understanding across the country, there's people standing in line with really, really, really good credit and a great financial situation for a renter, standing in line to get into some of these single family investments. So if you ever thought that a single family investment may not be the best place, there might be something better, you might want to think a second time. We have completely changed human behavior with what COVID has done. Humans are staying at home now. Humans are going to be working from home now. If you're involved in real estate investments on the single family environment, for this particular situation, long-term financing like this, you're not taking advantage of it now, you're shooting yourself in the foot in a big way. Now, I did talk about rates going up. I'm going to give one more quick story before we get into any things you want to hit on, Mark. This happened with a Memphis investment property investor. 2017. This is when the Federal Reserve decided to start doing the quantitative tightening. If we go back to my chart real quick here, we can show where the interest rates. We can't get back into 2017 on this. It only goes as far back as July 26, 2018. But we are coming from a much lower position to get there because the Fed started doing a little bit quantitative easing again in 2018. But the reason I point that out is the Fed was dumping in still billions and billions of dollars per month up until the end of December 2017. Well, we had a mutual client, 2 new build properties there in Memphis, same price, same street, same rents, same damn floor plan. The only difference was you guys had the garage on one side of the front door on one of them, the garage on the other side of the front door on the other. The other difference was you guys are just about doing the touch-ups on one to finish it up. The other had yet to break ground. So we're looking to close on the first one in December 2017, 4.75% interest rate, very happy client. You get to the end of, I think it was May 2018, when the second one was done, quantitative tightening kicked in. The interest rates were sitting somewhere in the range of about 5.75%. So you remember what his reaction was when I was getting ready to lock that in?
Shocked.
He was looking to cancel.
Yeah.
He was going to cancel that purchase. And yeah, shock is exactly what it was. He's like, that can't be. That's 1%. And he said, what's the difference in payment? And I gave him the payment. He goes, dude, that's $49.97 different than what I'm making in cash flow now, because I'm losing $600. I think I'm going to cancel. So I had to ask him, I was like, how is it you figure you're losing $600? He says, well, if I'm putting the same amount of money out and I'm making $49.97 less because of the higher payment on the property too, that's $600 a year. I think I'm going to cancel. I asked him to do one thing for me. Now, each person has to do it on their own, but this was him. So I asked him, listen, contact your CPA. Ask him a couple things. It's May. You just finished taxes. Ask him what's the difference in the taxes you'll pay on the higher income property number 1, right, versus the lower income on property number 2. And then ask him what's the difference in the tax deduction you get on the higher interest rate on property number 2 versus the lower interest rate on property number 1, and then let me know. So he went ahead and did that. 3 days later, he calls me back, says, go ahead and close. And I said, why are we closing? So it was no longer $49.97 per month difference in interest rate. I mean, difference in payment. It's like $3.55. Let's go ahead and close. So the reason I share that.
Huge.
What's that?
That's huge. That is
It's
just
massive.
incredible. Yeah.
Massive, because it gets down to, guys, this is a business. It's not a matter of just what is the bottom line cash flow and what's my rate look like and all that. I get all that. Those things are good things to look at. But ultimately, when you're running it like a business, and you have properly set things up with your CPA, and you have properly put things together with your business structure, it's the most tax favored asset class on the planet. You set it up right, it works out very well for you. Yeah, you have to do some legwork. This is easy. I mean, this is not easy. You want there to be hoops to jump through. That's what keeps your competitors out. That's what keeps the people out of it that doesn't know what they're doing. You want people to go in there and not screw this up. So you want to go in there and do it right, do it with the right people, get the right teams. So you start to see it doesn't matter. Interest rates are going to go up. As rates go up, you get to offset that with your taxes. It all works out. So you need to remember, 3 things you got to remember: leverage high, leverage long, and pay off slow. And then, of course, the 4th thing, you got to get a damn good team. If you do all those things, I would say your success is not going to happen immediately, but it's fairly assured if you do the right things.
Amen. I love what you just said there. It is so much more than just finding the lowest interest rates. You obviously have to look at the big picture. The big picture means you have to educate yourself a little bit more. So that's the whole reason why we've decided to put on this SOFA Summit for you guys, so you can really dive in deeper to say, well, what is the true total ROI? What is the big picture? What's the full benefit that I'm actually getting from investing in real estate, as opposed to who's got the lowest rates? What is the best product out there?
Most definitely.
Well, that's it. That's all we have for you guys. We really appreciate it, Aaron. Hope everyone enjoyed the session here today. How should people follow up with you, get in contact with you if they're interested in continuing this conversation?
Definitely go to aaronbchapman.com. There's videos on there you can check out where I go into, if you go into the media section, you can see that I have videos I put up twice a week about the market, things like this, what's happening in the market that's driving interest rates. You want to keep up with that, you can go ahead and subscribe to that channel. I've got 4 books out. You can get you some information through those 4 books. You can check me out on the NMLS just to make sure of what license I have. That my NMLS ID is 267844. So there's a consumer section, and we're also getting ready to launch another YouTube channel that has to do with really helping people get off their ass and get out there and do something. We want to showcase people that are doing stuff that's a little bit different, Also showcase people that have become successful, even though it's not easy to be successful. Sometimes it's easy to get it, but it's not easy to retain it. It's a lot of work. And I want to give people the best strategies and best information out there. So there's a few things we're working on. But just go to aaronbchapman.com, B as in Bravo. Not my middle name though. My dad was military, but he didn't get that crazy with it. And anytime you guys want to chat, just set up a time with my assistant Samantha, and we'll schedule some time. We can spend a half hour on the phone and dig deep into your situation.
Awesome, man. Well, thank you so much, Aaron. And thank you everyone for watching this session, and have a great day.
Appreciate you, man.